So what's good, good morning. Please kindly share your video so that we can confirm that your video and your audio are okay. Good morning, everyone, and welcome to this webinar. May I please crave your indulgence to give another 5 minutes to allow more of our members and more of our participants to join. For this webinar, we are pleased to inform you that over 250 people registered, and we're likely to start once we have a significant number. And the whole idea is to ensure everybody gets, gets a piece of the knowledge that we're about to receive at this webinar. So please permit us another 5 minutes to allow more of our registrants to join this. Then we will kick off immediately. Mr. Wotugashi, kindly share your video so that we confirm that your video and your audio are good. Thank you.
Good morning, sir. Please confirm you can hear me.
Yeah, I can hear you.
Okay, I'm trying to set up my video. Just a minute, please.
Thank you.
Yeah, Mr. Adime, please confirm you can see me and you can also hear me. Hello.
Yeah, I can hear you and I can see your video. Thank you, Mr. Wotugashi. I will join you shortly. Thank you. All right. Thank you. Good morning once again to those that are just joining us. And I thank you for our patience for those that have joined since 10 o'clock. We really appreciate that. And then as earlier mentioned to us, the purpose for that delay is just for us to have some of our members, some of our friends, colleagues join this webinar so that we all can enjoy that knowledge from that we will gain from this webinar. So once again, we say good morning to each and every one of us, and welcome to this webinar. And you will agree with me that this webinar is beyond understanding the implication of the new tax. It is not just for regulatory necessity. It is a strategic imperative because whether you like it or not, the new law for our tax has come and it has come to stay. So it is a strategic imperative for both corporate and individual, and that's why we are organizing this webinar to ensure that it covers everybody, both our corporate, both our members, both and some of our some other institutions outside our space, and of course every individual present here, so that we all can have a knowledge of what this new tax law is, especially in relation to our bottom line. Then the changes introduced have far-reaching consequences for individuals, and you will agree with me with that, for corporate and investment managers alike, particularly in how we impact profitability, reporting obligations, and overall financial decision-making. Now, this webinar has been thoughtfully organized to equip every participant present here with practical knowledge and actionable insights on this tax. Then our goal at this webinar is to ensure that every participant leaves here with a clear understanding of the new tax framework, how it affects your bottom line, and the steps required to navigate it effectively while maintaining full regulatory compliance. So we are privileged to have with us today an accomplished facilitator. And I can say this categorically because I've sat in webinars that he anchored from some other people. There was one that he has already anchored for Notch HR. In fact, that was the one that I attended that prompted me to bring him to us, because it was so very, very insightful webinar he had with company. And so we are privileged to have him here. Mr. Adefolari Awotugashe is a certified trainer on the new tax law. He's a chartered accountant and also a chartered tax practitioner. Now, his depth of expertise and practical experience uniquely position him to break down the complexities of this law into clear, relatable, and applicable insight. It is extremely for us to get everything from this webinar. So during the webinar, we can expect a comprehensive overview of the new tax law and how its key provisions affects us. So we will debunk all the myths and all the comments and ongoing things that we must have had with respect to this tax. Also, there will be practical guidance on managing tax obligation effectively. This webinar will give us insight into compliance requirements to mitigate regulatory risk, both for individual and for corporate. Also, it will strategize, it will help us to strategize in a way to optimize our tax obligation. So this morning, I bring to you Mr. Awotugashe, Mr. Adefolari Awotugashe. Permit me to read his short profile to us before I hand over to him. Mr. Awotugashe, please kindly bring up your video. Mr. Adefolari Awotugashe is a chartered accountant and licensed tax practitioner with experience in accounting, taxation, audit, financial reporting, and corporate advisory services. He provides compliance and advisory support to SMEs, non-profit, and growing businesses with strong involvement in tax audit, regulatory filing, and engagement with FIRS, state IRS, and the Corporate Affairs Commission as an accredited agent. He has a keen interest in audit and accounting ethics and tax administration, and is committed to delivering practical, ethical, and sustainable financial solutions that support business growth and regulatory compliance. He is a certified trainer by the Presidential Fiscal Policy and Tax Reform Committee on the new tax law. He is also the managing partner of Adefolari Awotugashi & Co., a chartered accountant firm, and Flow Professional Services, a growing tax consulting firm in Nigeria. As we welcome Mr. Awotugashi to the floor to share his knowledge on this new tax law and also how we can manage a tax law in relation to our webinar, may I humbly request that we all mute our phones, and then if we have questions, please, we can begin to put our questions on the chat box or get them ready so that after his presentation, we can all ask our questions. And I can promise you that we will get all our questions answered from this meeting. Mr. Awotugashi, over to you. Thank you again, and we trust that we'll enjoy all from you this morning. Over to you, Mr. Awotugashi. It's not here any longer. So sorry, I think he's... Apology, participants. I think he's having... Okay. Mr. Awotugashi, are you here?
Yes, I'm here.
Okay. Please, over to you. You should be able to share your slides. You've been made a presenter.
Yeah, I can see that. Can you see my...
Not yet. Not yet.
No, my camera is not coming out.
Yes, your camera too is not coming up.
Just a minute. Can you give my other device an access to share my camera, please? I'll be using my phone to share my camera. I don't know what's wrong with my camera.
Did you mean the other line that you joined with? I can see Adefolari. Okay.
Yes.
All right. I will make that a presenter down. Yeah, so you have been made a presenter from that line as well. Sincere apology, participants. Our Nigerian network is the reason for this. Please bear with us. It will come on immediately. Immediately it sorts that out. So are you able to share your slides from that?
Please confirm you can see my screen.
It's loading. Please put on slide mode.
I just wanted to be able to see first. Can you now?
It has gone now.
You cannot see it?
Yeah, it was loading before, it came on, and then it's disappeared again. I wanted you to put it on slide mode. That was why I requested for that, but again, it went off.
How about now?
Not yet, please.
Network.
Or do you mind I share with me the same one you sent to me?
Yes. You can please bring it up. I don't know.
Okay, all right. Let me share from my end here. Please, can everyone see my slides? Okay, are you sharing again?
Yeah, I'm trying to do it again. So let me see.
Okay, so we can see your slide now. Just put on slide mode.
So I'm putting on slide mode, so that's why I'm asking if you're able to see now.
We can see now, but it's not yet on slide mode.
How about now?
Yeah, click on that.
How about
Not, oh yeah, yes, yes.
Okay.
It's on slide mode now.
Thank you so
Thank
much.
you.
Apologies to everyone. I guess I might have to still put on my video later. Because of this network, I may not be able to put it on now. So let's begin with the webinar. So the topic before us this morning is mastering Nigeria's tax regime, taxation, and your bottom line. So how does it affect your bottom line? What do you need to do as a fund manager? What are the things that you are likely to come in contact with as this law is now being implemented? What are the new issues? What are the new developments? What are the things that have changed? Are there new taxes that have been introduced? Are there taxes that have been taken away? All of these things are what we would look into at this time. Without wasting much of our time, let's talk about what are the things we'll be looking at this morning. So the first part we're looking at, what are the key tax changes under the Nigerian Tax Act of 2025? What are the impacts of these changes on investment funds and portfolio management? What are also the compliance obligations for fund managers? So me as a fund manager, what are the things I need to know? What are the things I need to comply with? How are things changing? Then lastly, we're looking at tax planning strategies for funds and investors. So myself as an investor, if I invest, what are the problems I'm likely have? If I myself as a fund manager, what are the problems? As a fund, being a trustee, what are the issues? So these are the issues we'll be looking at this morning. So basically, we'll first be talking about the key features in this new tax law. Before now, we have over 30-something tax laws in Nigeria. So we have the company income tax, we have the personal income tax, we have the education tax acts, we have the value added tax act, we have the withholding tax regulations, you have a lot of them, they are just all over the stamp duties, these, that. So all of them, they are just all over the place. So even compliance becomes difficult at times. For some people that I've seen, some clients, when you are done with, or when you engage with them, when it comes to tax issues, they'll be like, okay, so I filed my tax. So why should I file for my company again? So all of these things are just scattered all over the place. People are just confused. People do not know what to do. And then also there's duplication everywhere. But with this new tax law, what it has done is to merge all of these tax laws and then come out with just 4 laws, which have become acts. So the first part is the NTA, which is the Nigerian Tax Act. So what it has done is to ensure that all of the tax laws have been merged together into one. That's the Nigerian Tax Act 2025, NTA. Also, as we progress, we'll be seeing NTA. So what it does is that all the tax laws, it merged all of them into one. Then also, we have the NTAA, which is the Nigerian Tax Administration Act. What this has done is to say the Nigerian Tax Act has spoken about how taxes will be levied, what is taxable, what is definition of income, what constitutes income, what constitutes taxes. However, how do we do these things? So it's a matter of we have the issue and how do we address the issue, or how do we enforce or implement these taxes? That is what the NTA is talking about. So it's now looking at the administration of all of these taxes. Okay, when should I file? When should you file? Why should you file? When you are expected to file? All of these things. That is what the NTA talks about. Then we have the NRS Act, Establishment Act. So what that says is that by 31st of December 2025, what we all know as Federal Land Revenue Service, FIRS, was buried, and a new creator arose after the burial, which is NRS, which is the Nigerian Revenue Service. So what that means is that FIRS before now was limited in scope to just taxes. Now the scope has been expanded to all parts of government revenue. So what it is that instead of just having only tax administrator, now they have now become revenue administrator for all the tiers of government. So when I say all tiers of government, every revenue that belongs to Nigeria, they are now collecting. Then they transfer to the taxation account for the sharing that is being done every month by the Revenue Mobilization and Fiscal Committee. So now, before now, if you want to pay, maybe you want to clear your goods, MPA, port charges, and all of that, you are paying at every point, all over the place. But with this new revenue service now, it means that whatever you want to do will be done in one place through a single window. You don't have to be going all around anymore. That is what the new NRS Act stipulates, that now they are in charge of revenue, not just only taxes. Tax is actually just one part of revenue. It is not the whole part. In Kenya, in UK, the same way they all have it, that their tax system or the tax administrator is not different from the revenue administrator. So they are in charge of all revenue. So you don't have to be dealing with different agencies paying them all over the place. So now, coming back to why we are here, and then the last part of the 4 acts is the JRB, Joint Revenue Board. Before now, if we are inclined, we know what we call Joint Tax Board. So the Joint Tax Board is there for managing all the state internal revenue services, and then with the FIRS in between as well. So they are there to actually do that administration. But with the new Joint Revenue Board, they are now much more synchronized. There's now much harmony between them. So one of the example is before now, if you have a tax, if you have some of your staff residents in Lagos, and some are residents in, let's say, Akwa Ibom, some are residents in, let's say, Kebbi State. So all of them, and even you as a company, you would be required by the State Internal Revenue Service to open a file, and they will give you what we call tax ID, or maybe tax identification number, or payer ID, as the case may be in Lagos State. Let's use Lagos State as a case. You open across all of these 36 states and the FCT. That means that, so if you operate across all the 36 states and you have staff that are residents in all of those states, it means that you must have different thing or different tax ID across all the 36 states, and which is what has been. The same thing for staff. So let's say you spend 1 year in Lagos, then they move you to Ogun State. You're also required to get their own thing so that they can remit your tax. Then you move there from maybe to Ondo State, they also do the same thing. So what they have now done is to say, you know what, instead of having all of these IDs all over the place, let us now match everything into just single one. If you have an NIN, then you have a tax ID. What you just need to do is to use your NIN to generate a tax ID. So in the future, a very, very near future, all of these IDs will be harmonized into just that single one, tax ID. So you don't have to go to another state and be opening another ID, or you go to another state, you open another ID for your staff. So now that ID that they have that is linked to their NIN will now be obtainable and be used all over the 36 states and the FCT in Nigeria. Now, what has changed? Capital gains have now been aligned with corporate income tax. The same thing, there has been a revision in personal income tax bands. So before night, the highest is 24%, now it's now 25%. New development levy. So instead of having what we call education tax, police trust fund, now it is no longer the case. Now what we have is just development levy. And then the Tax Act also stipulates how this fund will be shared amongst all of these agencies. You have the NITDA, you have police trust fund, you have NASENI, you have tertiary education trust fund. So all of them, they have how they will share this money. Also, broader taxation of investment income and offshore transactions. So now this means that if you have any, let's say you are not resident in Nigeria and you are doing transactions in Nigeria, if you have any revenue from Nigeria, then you be taxed on that revenue from Nigeria. That's what the tax law says now. Or let's say you spend over 183 days in Nigeria, then you are liable to pay tax in Nigeria on your income because you are then regarded as a resident tax person. So now, with this new acts, there are definitely bound to be changes and a lot of uproars are everywhere. Oh, this will be taxed from your bank account. All of this information and misinformation are just all over the place. So people are being...
Sorry, Mr. Wotugashi. Your slide is still on slide 1. I don't know whether you have...
I'm just
okay.
all
right. Okay.
Tax.
Okay. All right. Yeah. Thank you.
So all of this information, misinformation are just all over the place. People are just confused. People don't even know what it is. So many misinformation all over social media. Content creators just come up, create different content to scare people. Some people say, oh, if you want to build us, you'll be paid 20%. So many information that do not even align with the tax laws. So now let's delve into why we are here today. So now let's talk about the corporate income tax and fund structures. So this now is applicable to all asset management companies, fund management companies, investment advisory firms, etc. So what are the key provisions in this new tax law? So now, CIT remains 30% for large companies and 0% for small companies. So some people are saying, oh, because you are 0%, then you are tax exempt. No, that's actually a misconception. What the tax law requires is that before now, we used to have 25 million as the threshold for exemption. So if you are less than 25 million, you do not pay tax. So if you're now from 26 million to 100 million, you pay 20%. If you're now 100 million above, then you are regarded as a big company. Then you pay 30% for large companies. But with this new tax law now, there's nothing like small, medium, and large anymore. It's either you are small, below the threshold of 100 million, or you are big, which is above 100 million in terms of revenue, and then an asset base of 250 million. So it doesn't matter if you make 101 million. No. So far you are above 100 million, you are then regarded as a big company. So the difference between the two of them now, where we have large companies and 0% for small companies, is that for small companies, you will still be required to do everything you are expected to do. You are expected to submit your audited financial statement to the revenue service. Also, you are also to prepare your tax computation. However, when you are now doing tax, instead of saying tax at 30%, you now say tax at 0%, which becomes 0 at that point. So there's one misconception there for a lot of people, and it's a lot of feedback that I've also gotten at different forums. People say, oh, it's 0%. Therefore, I do not have any business filing my account. That is wrong. Don't make that mistake. So even for us as fund managers, even if you say, oh, our revenue over the funds we have managed is just 60 million. Therefore, I do not need to file. No, you are paying with late penalty and interest. So the best thing is you do everything that you are supposed to do as it is. However, at the point of calculating your tax, you then become 0%, which at the end of the day becomes 0 for you. Now, I've also mentioned the development levy now is 4% on accessible profit for companies, excluding small companies. So if you are a small company, you do not have any business with all of these taxes, and which is one of the plus for this new tax law. You do not have to stress your head if you are less than 100 million, because it's to also encourage entrepreneurship development, to ensure that, okay, people are able to do business. And doing business, you give them, the small businesses, you give them good air to breathe so that they are able to also grow. Because no government in the world taxes capital or taxes poverty. Only tax profits. So if you're not taxing government, businesses less than 100 million, how do they even want them to survive? Not even the current economic situation of Nigeria. So in reality, we have to consider all of this, which are why the new tax law have reduced, have increased that threshold to say, okay, instead of 25 million, it's now 100 million revenue. If you do not make 100 million, you do not have any problem with us. However, file. So it is when you file. So it is just like you have a case at the police station, your phone has been stolen. You did not report. The police tell you, sorry, we did not have any report that says this thing was missing. So it is best that we file our tax and then we move on. Then also there's something called in this new tax law, which is a minimum effective tax rate. So for large multinationals or companies doing 200 billion revenue in a year, they may face what is called 15% effective tax rate, according to Section 57 of the Nigerian Tax Act. So what this means is that, so for companies that are big, making so much money or a part of a large multinational good, because it's the same thing in all over the world, that you have a minimum effective tax rate that you have to pay, which is a 15%. So if your tax is not up to 15% of your EBITDA, then you have to go back to recompute to ensure that, yes, it is up to 15%. If not, when the NRS come, they would add it. Then they will still tax you to come up to 15%, which is what is available, and also obtainable across different jurisdictions that tax is practiced. So what are the implications of this for fund managers? So as a fund manager, you have to reevaluate your profit allocation structures between the fund manager, and the investor. So how does this work? So you have to evaluate this carefully so that you do not pay tax at different stages. It's very important, I have to answer this again, that we have to evaluate this carefully so that we don't pay taxes at different levels, either at fund level or profit, fund manager level or at the investor level. So we have to consider all of these things carefully. Also, we have to consider the fund and manager taxation. So here, it's very important for us to ensure that we carefully consider, because of double taxation, unknowingly, we could be a victim of double taxation as a result of not carefully considering this. And then also, we also need to consider that there's now increased tax cost due to development levy. So what it is before was 3%. Now there is now 4%. So which means that our 3% is no longer valid. It is now 4%, which means that there's an extra 1% that is going out of your profit. So we have to put this in mind. These are another implication. Then we also have to review management fee structure, which is very, very critical, because for a lot of us that are fund managers, we either make our revenue from either spread or management fee. So because for management fee, there's a VAT implication, we have to consider this. There's VAT implication, but when you are doing spread, making money off different funds, you do not have issue of VAT. But for this, you have VAT implication. And also, part of the new tax law is talking about fiscalization. So fiscalization is talking about e-invoicing, whereby the invoice you are sending would no longer be through the normal invoice. Then it will now be passing through a system whereby the NRS would authenticate the invoice before you send it to your clients. So that has been going on since last year, and then companies with over 5 billion revenue, they've been asked to ensure that they move along this trend to ensure that every company doing over 5 billion, they have to be done by end of March. So it means that by the end of March, every company over 5 billion would have to be going through e-invoicing. And at the same time, for companies with lower revenue, the thresholds has also been set and the timelines have also been set. And this is also an implication for fund managers, because it's an additional cost for us as fund managers. The cost of integration, is a cost for us. And then also, possibly cost of renewal every year is also a cost we need to also consider. So these are implications for us as fund managers. So now let's talk about something very, very critical for us as fund managers, capital gains tax. Sometime in November last year, there was a publication that, oh, for every investor, they will be taxed at 30% on their profit. So a lot of people decided to sell their shares, sell their stakes and all their assets, all their financial assets that day. And it was indeed a black, I think it was a Tuesday. It was indeed a black Tuesday in this history of Nigeria because a lot of people lost so much money. The capital market went down badly that day. And this was actually as a result of misinformation. Nothing but misinformation. So what the tax law is saying is not saying you'll be taxed at 30% outrightly on your capital gains. In fact, with this new tax law, I can even say capital gains tax is no longer in vogue. There's nothing like capital gains tax anymore. That's the meaning. And I would explain. That's the implication of what it is in the new tax law. It's saying that there's nothing like capital gains tax anymore. Because now, before now, if you purchase an asset, or let's say you have purchased shares at, let's say, 1 billion, then after 3 years, you are now disposing it off. You are selling at 3 billion. So automatically, what that means is that 2 billion is a capital gain on that investment, because as of the time you're buying, it was just 1 billion. Now that you are selling, it is 3 billion. So it means you have made an extra revenue of 2 billion. So what it is in the old tax law is that a 10% flat rate of capital gains tax is applied, which is about 200 million on that gain. What the tax law is saying is, no, do not do it that way. Add it to your income. So let's say, as a company, what you have is you have your normal revenue from your different trading activities, fund, placement, and all of that. So you have so many funds. Let's say you have 3 billion. Then you have now add a capital gain of 2 billion. So it becomes an other income for you. So at the end of the day, when you are now doing it, you deduct all your expenses, you arrive at your net profit, you do your tax computation. Then you are now applying the 30%. So instead of saying, excuse me, at the point of disposal, you are paying 10%, and then it will still be added to your revenue again. Now, you are only adding that capital gain into your revenue as another income. So you do not suffer capital gains tax anymore. So now, what you are now paying is just company income tax flat. You are no longer paying capital gains tax before, and then you are still paying company income tax on it again. That is no longer what it is. So, and then when the analysis was done for that day, that the stock market went down, what was discovered is that a lot of people that even sold off their investment do not even meet the threshold for capital gains. So a lot of people that sold panic sale that happened that day, they do not even meet up to what is even required to be taxed. So now there is an exemption threshold. So share disposals may be exempt where the total proceeds is less than 150 million. So if what you are disposing is less than 150 million, it is exempted outrightly according to tax law. The new tax law, it is exempted. And if the gain you have also made in that same year without is also less than 10 million, it is also exempted. So when the analysis was done, it was discovered that a lot of people that disposed their assets that day, they do not even have up to 150 million worth of assets. So at the end of the day, a lot of people just sold their sale just to quickly exit because they don't want to pay 30%. Meanwhile, it was a wrong perception that was given to people. So people were misled with that information. So it was a total red for a lot of investors that day. So now, what the capital gains is also talking about on indirect share transfer. Let's say you have a stake in a company and then you are exiting. So let's say at the point you are buying the shares was, let's say, 10 naira per share. Now you are disposing, it's now 15 naira. Automatically, there's a 14 naira gain. which is also subject to capital gains. So not tax at this point, capital gains that will now be added to your income. So the same thing also is also applicable to individuals. So don't forget, when I started the webinar, I mentioned something about tax band being expanded. So it's now up to 25%. So for excuse me, for a lot of us that are that are individuals, what happens is that instead of paying capital gains and then you are still adding the gain to your income when you are filing your tax, what the law now says is that just add only the gain to your income. Do not pay any capital gains tax anymore. So whatever you are now paying will now be part of your income that will be put on the tax table that you are now taxing. So you are no longer taxing the capital gains separately. And now, what are the implications of this for fund managers? So for private equity exits, automatically, there will be capital gains. So you have invested, you are now taking out what you are taking out is subject to capital gains. When you compare what you have invested compared to the value you are taking out, definitely there will be capital gains. The same thing with venture capital. So for a venture capital, when you are exiting, you also have exposure to capital gains. So for fund managers, you are able to advise your clients properly, most especially non-resident clients. So that do not even reside in Nigeria, they are not familiar with our tax law. So they are able to also understand the implications of, the tax implications on their investments at the point of exit. So that there are no surprises. The same thing with real estate funds. You have also provided funds, you have done real estate, now you are selling off. The amount you have gained is also subject to capital gains. The same thing with share portfolio restructuring. Now, fund managers must now consider that there are higher exit taxes. So you have to take that into consideration as a fund manager. You also need to structure your offshore holdings. So there's something I think I omitted. Now let me bring it up. So there's something called control foreign subsidiaries. So in this new tax law, it's saying that if you have a subsidiary abroad that has made profit and then decided not to pay you dividend, the tax law is saying that dividend that is due to you will be assumed to have been paid to you, have been taxed in Nigeria. So let me take that again. It might be confusing. So let's say Amade Folarin, I have a company A in Nigeria, and that company A has a subsidiary in Kenya, which is company B. That company B has made so much profit. And at the point of making so much profit, let's say I have 80% stake. Automatically, let's say it makes $1 million as profit. That is distributable to shareholders. And I'm supposed to take 80% of that. But because I do not want to pay tax in Nigeria, because when it comes like an order income to me, and I don't want to pay tax, I decided to leave it there. So what the tax law is saying is that at the point where you do not bring it in, it will be assumed that it has been paid to you and will be taxed in Nigeria. So this is actually to avoid base erosion and profit shifting. So for a lot of us that are familiar with taxes, and then when it comes to international taxation, there's what we call, I think, Pillar 2, Action 13 for the OECD. So what it says is that for base erosion, because we do not want you to erode our base. So instead of paying tax here, you have decided to shift it to a tax haven or to a place where you will not pay tax. And then you think we will not tax you. No, we'll tax you. So whatever profit or whatever investment you have abroad that has made you money as a company, and you decided not to bring it into Nigeria, especially dividend, we would assume that it has come into Nigeria in your books, and then we'll tax it in Nigeria. So a lot of multinationals do this so that they are able to shift profit away from one country to the other. So many countries have also adopted this formula. So they do not rely on that. So when they see that you have dividend abroad that you have not claimed, that has not been paid to you, they would assume that it has been paid to you and then tax it in that home country. Now, let's talk about personal income tax. This is also a very important aspect, as this affects every one of us, irrespective of either we are business owners or we are employees, we are whatever we are. So everybody must file their personal income tax. So Section 13 and 14 and subsection 3 of the Nigerian Tax Administration Act states that every individual that earns a taxable income must file their personal income taxes. So what does this mean? So I've had so many feedbacks. People are telling me, oh, my company has filed for me now, so why should I file? No, because your company has filed for you does not mean you should not file. The tax law requires you that you as an individual, you should also file your tax. And when you are filing this, and the reason is very simple. So let's say I'm an employer. I've employed 5 people and I've paid them 5 million in 2025. I only know to the extent of the salary I have paid them. So if they have any other sources of income, I do not know as an employer. I can only file to the extent of what I know. So if myself as an employer have filed for you, then you as an employee, you must also file for yourself to disclose all your income, because it might be possible that it is not only the employment income that you have earned that you are now that you rely on. So you also need to file. You file your employment income. If there are other sources of income, you file. And I have a video on this on YouTube. The video will be shared. The link will be shared on this meeting link. You are able to see how you can also do that, especially for those of us that are resident in Lagos State. And then if you are outside Lagos, on my website, on my friend website, you would see the website for all of the state internal revenue services and the FCT. You would see their website there. You are able to go there and do their own filing. So it's almost the same thing as Lagos State. Worst case, you can go to any of the tax office close by for them to guide you on how to do your personal filing. It is very, very important that we all file our personal income taxes. Compliance is cheaper. We need to avoid this. Now, what has changed in the new personal income tax laws? First thing is that any individual that is earning less than 800,000 naira annually, they are automatically exempted from personal income tax. So if you earn less than, if you have any of the employees that earns less than 800,000 naira annually, they are exempted from paying this tax. They do not have any business with the tax. So, and then the good part of it is that even if you earn less than 20 million naira per annum, your tax would come down. That's just the truth. But if you earn more than 20 million naira in a year, you are likely to have higher tax. But for people below the rich line, you do not have much exposure. In fact, your tax will come down. Now, the new tax band, there's a revised tax band. So as what we have before, that is just up to 25%, 24%. Let's say after the 3.2 million at 24%, now it is now 25%. However, the tax band has been reshuffled, and also what we call consolidated relief allowance has been taken out in the new tax law. There's nothing like consolidated relief allowance anymore. What you now have is rent relief, which is 20% of your annual rent, subject or capped at 500,000 naira. So if your rent is even 10 million and 20% of that is let's say it's 4 million, you cannot claim 4 million. The highest you can claim is 500,000. You can't claim the 4 million. That's what it means. Also, for a lot of others does a lot of different contributions, like the pension scheme, like NHIS, that we have any real estate, mortgage that we are servicing, the interest is now exempted from tax. So it's now a relief that you can use to reduce your tax liability. So if you have any mortgage that you are paying, all of these are now exempted. They are now agreed as a relief to you that you can use to reduce your taxable income. So another thing that has changed is the residency rule. So what it says is that if you spend 183 days in Nigeria, then you are assumed to have a permanent establishment in Nigeria. So therefore, you are paying tax in Nigeria. So now, this is where this can get dicey and confusing. For some of us, and for some people that do, let's say, remote work. You are in Nigeria and then you are doing remote work for a company in US or UK or Canada. You actually, and you spend more than 183 days in Nigeria, then your tax on that income, even though you didn't earn that income in Nigeria, you would have to pay it to Nigeria. Let's not confuse it. If you are resident in Canada, you do not pay the tax in Nigeria, provided you do not spend 183 days in a year in Nigeria. So for some people that have, let me just use a very funny and familiar scenario. Let's say you have two wives, one's in Nigeria, one is in Canada. You spend 6 months in Nigeria, you spend 6 months in Canada. If you are not careful to be mindful of the residency rule, you'd actually pay tax in Nigeria and also pay in Canada. If you are not very careful. So these are some of the other things we also need to advise our clients as fund managers. Then there's something called permanent establishment, which I have also mentioned, that if you are not careful, when you are, let's say, I'm into logistics, but I'm based in UK. In Nigeria, I am now, I have a warehouse in Nigeria that I'm now subletting even to some people that I'm holding items for them there. You are creating a permanent establishment. Or normally, you are creating a permanent establishment. Or let's say you are in the US, then you are negotiating contracts, you are closing out deals for your company in Nigeria. You are also creating a permanent establishment because now the next tax nexus has been expanded. So what links you to Nigeria is now much more than what it is in the new, in the old tax law. And then also benefit in kind was also mentioned in this new tax law. Under the new tax law, so accommodation that is provided to you as a company is also a benefit in kind, because ordinarily you would have gone to pay for that accommodation if the company had not given you. So at the end of the day, if you look at it carefully, it is also an additional allowance to you. It's an income to you. However, the new tax law capped it at 20% of your annual salary. Let's say your company has given you an apartment in Banana Island, and that apartment costs 100 million naira per annum. Ordinarily, in the old tax law, it is actually the 100 million that will be capped because it is benefit in kind. But with this new tax law, it's now saying it's only 20% of your annual salary. And let's say your annual salary is 50 million per annum. So it is just only 10 million that will be added to your income to be taxed. The same thing for official car. So let's say you have a car that has been provided to you by your employer. The same treatment with the accommodation applies. However, for this one, it is now 5% of your annual salary. And how does this how does this even relate to a fund manager? So this means that there is impact on carried cost. Interest on carried interest. So whatever carried interest you have, then you also have tax obligations because this would also accumulate to part of your income. The same thing, you also have tax planning on expatriate fund managers. I had mentioned it earlier that you have to be very careful so that you do not create a permanent establishment unknowingly. And then I also mentioned that global income taxation for Nigerian residents. So if you're a resident in Nigeria and you have other income that you're earning from different other countries, that income is subject to tax in Nigeria. However, there's a twist to this because a lot of people argue that, oh, I have this money before it was paid to me in the US, they've taken out a withholding tax. It's just unfortunate that Nigeria do not have a tax treaty with the United States. But we have with Canada, we have the United Kingdom, we have with France, we have with Singapore, a lot of other countries. So let's say you are in UK or let's say you are in Nigeria and then you have earned income in the UK. Your employer is paying you are now deducted withholding tax. You can use part of that withholding tax. You can use the withholding tax to come and reduce your tax burden in Nigeria. It is allowed under the tax law, because there's a tax treaty that is signed between Nigeria and UK on double taxation, so that that income does not suffer double taxation. So if in the UK, excuse me, they have taken withholding tax, let's say they have taken 5% as withholding tax remitted there, you can use the certificate that they have issued to you in the UK, bring it to Nigeria, file it in the international tax department that, oh, I have brought in my certificate. This income has suffered withholding tax from another country. I also want to use it because based on the tax treaty that Nigeria has with this country, I need to use it to reduce my tax burden. Very, very allowable. You can do that. It's also something we also need to also inform our fund manager, our clients, most especially the ones that have different sources of income all across the globe. Now, withholding tax. What has changed in withholding tax? Or what does withholding tax mean? How does it even work? So we have different things of withholding tax. Is it another tax? Is it what is it? Let me just explain to us that withholding tax deduction is not another form of tax or additional tax. No, it's actually an advanced payment of tax that you can also use at the end of the day to offset your future tax liability. Now, let me give us an instance. I have invested with Stanbic Money Market, or let's say Stanbic. They've done a fixed income. I've done fixed income. Then they've charged me withholding tax. Now, if I want to file my income tax, I will use part of that withholding tax to reduce my tax liability. Let's say what I have suffered is 1 million naira that have been deducted. Now I have come, I want to file my tax, and my total tax liability at the end of the day is 2 million naira. What I'm paying in cash to government is just 1 million naira, because 1 million has already been deducted ahead. And let me give us the reason why this is done. So it's just like government is saying, I cannot wait for you or till the time you would file your income tax before I would have cash, or before I would have inflow from you. I cannot wait till that time. So we all know that you are filing your account maximum of 6 months after your year end. So let's say your year end is December. You are filing your tax 6 months, which is June. Except for us that we are highly regulated by SEC, that we have to file by 31st of March. So now, for tax purposes, you are expected to file by 31st of the following year as a company, and then as individuals, 31st of March of the following year. So if at the time you want to file, it means government would have to wait for a whole year and 6 months before they can get any taxes from you. So government is saying, no, we have working capital demands that we need to meet with. We need to be able to have cash at every point in time we need it. So therefore, just deduct part of that revenue, pay it to me. Whenever he wants to now pay his final tax, then we will now do a final settlement to say, okay, how much have I collected in advance? Let's say your total tax is 10 million. Government has collected in advance 7 million. What you are now paying in cash is just 3 million. So that's why I explained that withholding tax is not an additional payment of tax. It is just that you are paying your tax ahead before the time you are now paying the final tax. So now there's an exemption for small business. And in the withholding tax regulation of 2024, transactions under 2 million monthly were exempted if the supplier have a valid TIN. This was because before now, like I mentioned, the threshold for small company was 25 million. So if you divide 25 million by 12, so that's about 2 point something million. So the government just started to take 50 million per month So now, because the new tax law is increasing the threshold for small companies to 100 million, it then means that the monthly transaction will be increased. So that's why I said in my slide that it is likely to go up to 8.3 million. So because now the government is here to issue out a new guideline on that process. The guideline was issued by Federal Ministry of Finance in 2024, withholding tax regulation 2024. But for 2026, we are still expecting that the government would issue through the Ministry of Finance that, okay, so if you are a company with less than that is that in that threshold bracket, then definitely you would have this reduced. Now, the new directives require withholding tax on interest from short-term securities, including treasury bills, corporate bonds, and promissory notes. I'm very sure a lot of us, and then I think SEC also published on his website sometime last year, there was an MOU or an agreement with the FIRS then to give a moratorium to us regulated companies that, okay, for all instruments traded in the short market instruments, they should be exempted from withholding tax. However, it ended last year, except maybe SEC is also pushing to enjoy another moratorium, which is very possible SEC can actually push on behalf of the companies it regulates. So now the implication is that there's reduced yield on fixed income portfolios because of withholding tax. There's impact on money market funds. Then there's increased compliance obligations for custodians and brokers. So for you as a custodian and as a broker, you already know that you have compliance. If you fail to deduct that withholding tax, then the tax authority would come to you. You will now be held liable to pay that withholding tax that you failed to deduct. That's actually what the tax law says. So in a situation whereby you fail to deduct, then you are now liable to that withholding tax. So which is why I said these are implications for fund managers. So we have to pay detailed and classic attention to these things and these issues. Then other relevant taxes affecting funds. So we have VAT, which I had mentioned earlier, concerning the electronic invoicing that has been introduced for VAT compliance. And then what is the implication? So if management fees is subject to VAT, so if you have management fees that you charge your client, definitely you would be having exposure on this, because as the time goes on, the threshold will be lowered to ensure that every company complies with the e-invoicing. So like I mentioned earlier, you would have increased cost of compliance. So you are getting developers to do the integration to NRS API. So you need to pay these people that do it. So it's a cost that you have to bear. Also, tax on offshore digital services. So non-resident entities providing services into Nigeria may be taxed through significant economic presence rule. So I mentioned it earlier that if you have, let's say you have a warehouse in Nigeria and you are letting it out to people, you are making income, you are creating a significant economic presence. The same thing, you are closing deals for your company in Nigeria, then you are making significant economic presence in Nigeria. Now, offshore fund managers may now face Nigerian tax exposure. So if you are offshore and then you are making, let's say you are in Kenya and then you have a lot of people that you are managing funds for in Nigeria, you would have to face tax in Nigeria if you are not very careful of the permanent establishment rule. Now, so what are the compliance obligations for fund managers? So I have them in three. You have the tax compliance, you have the transaction structuring, and you also have the investor reporting. So now, accurate, when we talk about the tax compliance, so accurate withholding tax deductions. Now, this is actually a tax compliance for you. If you do not deduct accurate withholding tax, it means that the tax authority would come and hold you responsible for that withholding tax that has not been deducted, which is what it is for a lot of other companies except fund managers before now. So every other company, you have to deduct withholding tax, and where you fail to deduct, you would face the drum. Now, for fund managers, you have to be very careful of this. You have to deduct the withholding tax on those short-term instruments so that you are able to remit, and then you'll be free from the tax issues. If not, you are likely to create a future problem for yourself as a result of that. Also, timely filing of CAT and VAT returns, even payee returns as well. For payee that you have deducted, for VAT that you need to remit, for your CIT, you need to file on time and also ensure the accurate tax payment. The same thing with VAT returns, file your VAT as and when due. Also payee, file it as and when due. If not, they all have penalties and fines under the new tax law. Also, transaction structuring. So you need to be able to structure your transactions very well in a way that you do not have exposure to double taxation. Then you also review tax treatment of fund distributions. So at the point of distributing funds, you have to be careful of the tax implications. Also, in investor reporting, tax statements for investors, if possible that you're able to do it, you should be able to, you should come up with this, whereby your investors, they can see their tax statements, what you have deducted from them as tax. So they can also track and then go and claim their withholding tax to remit. Also, the same thing is capital gains tax tracking on disposal. So for whatever disposals that you are making, you are also tracking the capital gains on them. Then what are the tax planning strategies that you can even look at to help with all of these tax exposures? So we have the structuring strategies, the investment strategies, and compliance strategy. So strategy, the structuring strategy is maybe, excuse me, offshore fund vehicles. You have trust. Also, you can use trust structures. You can also use holding company structures. Then you have the investment strategies, exit timing optimization. So you have to be very careful at the time of exiting, so that you do not. Don't forget that I said if it is below 10, if it's below 10 million, another 12 under 12 months, you are exempted. But if it is more than 12 months, then you are liable. So you have to be very careful of this part. Also, tax efficient distribution policies. So at the point of distribution funds, you have to also come up with a policy that is efficient to guide the distribution and the taxes on this distribution. Also, compliance strategies that you can use is tax technology adoption. You can adopt a technology that would help you track your taxes, and then also early engagement with the tax authorities. So when you engage the tax authorities on time, it helps you to clear whatever issues or whatever problem you have. So what are the key takeaways from this webinar? So number one, capital gains tax increase significantly impacts investment exit. So because there's the capital gains has been increased, that it is now alongside with your company income tax, you are filing it as another income. So definitely your investment exit, there will be impact. And especially for those that do not even have economic presence in Nigeria, let's say they just came to invest in Nigeria, then they are liable to that CGT at 30% at the point of exit. And don't forget that for you to even get to that point, you must first pass the 150 million threshold, and then you must also pass the 10 million naira threshold for the gain that you want to look at. And also, if you are investing, it is also exempted. If you are investing that the income that you have gained, the gain into similar assets, then you are exempted. Then development levy increases. It increases your tax burden on companies. So, like I mentioned before, it was 3%. Now it is now 4%. So with 4%, there's an increase of 1% cost to the company. So this also needs to be put in mind. There's a new personal income tax structure, which affect fund managers and high earners. In fact, for people with high net worth or people with high income every year, they will also be affected, because as the tax ban has been increased to 25%, the same way their taxes would also increase. Also, there's withholding tax expansion that would affect fixed income investment returns. So all of this needs to be put in place. And then also the withholding tax on it needs to be captured accurately from your part as a fund manager, so that you do not have any exposure in terms of taxes to the relevant tax authority. Also, fund managers must also review their investment structures and compliance system. So you need to be able to review your system to ensure that nothing is missing, so that you do not have tax burdens that you do not plan for. Because for a lot of the clients that have worked on the account, some of them, they have their planning for the tax they want to pay. So they have the cash flow somewhere. So if you are not careful, you would have to look for additional cash flow to meet up with tax obligations, because you have not taken note of the compliance requirements for the taxes. So at this point, I've come to the end of the slide. I don't know if you have any questions that we want to ask. I can take them at this point. Thank you.
Thank you so much. So promise made, promise kept, promise delivered. And everyone on this call would agree with me that thank you for that thumbs up. If I can see more of those thumbs up and clapping for Mr. Otungashi, I would really appreciate that. And yes, there will definitely be question and answer. We have made provision for that in this webinar. And then before we just proceed, I know most of us, yes, we have a question. We're going to ask a question. Whilst he was speaking, especially when it got to the slides on strategies, I had to quickly, go and inform our MDs and CEOs to please join. And the purpose for this is that it's not that we are encouraging evasion, but we can strategize our taxation in a way that it pays us and it pays the government we are paying to. And you can hear from what he has explained to us, those how we can strategize our taxation through our offshore fund vehicles, through trust structures, holding company structures. So these are things that we can consider. Also in our investment strategies, how we can exit so that we don't cross the threshold of 12 months and then we have to pay. So there are a lot of, permit me to use the word, loopholes that we can hide under to reduce our tax obligation legally to the government from this new tax law. So again, we want to thank Mr. Otungashi. Thank you so much for that insightful presentation. So I would try and organize this question and answer session. Please, if we have question and answer, we would treat the ones in the Q&A section first. We will go to the chat box if there are anyone there too. Then we will take questions from hands raised. So in the Q&A section, I could only find one from Mr. Ige. So, Mr. Otungashi, question says, please differentiate under the new Tax Act of 2025, what tax regimes apply on earned and unearned incomes? Would they be assessed at the same tax rate for personal income tax? So I'll take the question again. Please differentiate under the NTA 2025. What tax regimes apply on earned and unearned incomes? Would they be assessed at the same tax rate for personal and income tax? Please kindly answer that.
Okay, thank you so much for that, Uncle and Mr. Bamidele. So the question I read again, please differentiate under the New Tax Act 2025. What tax regime applied on earned and unearned income? Would they be assessed at the same time? So for you that you are paying tax, whatever has been earned is what you are basically paying more tax on. So if I have something that has not been earned, so I've not even received it. So if I want to pay the tax, where would I even get the money to? Where is the cash to pay it when I've not even earned the transaction? So basically, if you have earned your tax, because tax is actually most likely, in fact, most times on cash basis, it is on what you have earned. So if you have an unearned income, so you still have something that is still coming, then you do not, in fact, let me just give us a typical example. During the former tax regime, before the introduction of, what is it called? Finance Act, then, before the introduction of Finance Act, we used to have situation whereby companies would have to borrow to pay their VAT. So when they are filing for VAT, they would have to file VAT even when the customer has not even paid them for this VAT. So, but if the Finance Act says it is only what you have earned, what has been paid to you, that you are now paying. So, but when it comes, so, and income includes your salaries, what is it called? Your salaries, your allowances, whatever you have earned, but your non-income, you're looking at maybe rent, you're looking at royalties and like. So what have happened first is there are two treatments. Number one, look at dividends. So dividend is being paid to you, but would have suffered withholding tax before it is paid to you. Then let's say interest before it is paid to you would have suffered withholding tax. So all of these withholding tax are what you would use to offset your future tax when you are now doing your final tax computation. However, the dividend itself is also an income to you and therefore not exempted, except you have not received the payment. If you have received the payment, definitely you would have to pay. The same thing with rent. Even for rent, it's just that a lot of us do not really practice this well in Nigeria. When you are even paying your landlord, you are even obliged to even deduct withholding tax before you pay the rent to the land, then remit the withholding tax on behalf of the landlord. But it's not so practicable in Nigeria because the landlord will just tell you, you know what, my rent is 2 million naira. Any thing you want to do of tax, it is your own problem. What I want to receive in my account is 2 million naira. So you go and deal with the rest. So all of these other earned income, they all come into your tax bracket. So if you watch the video that I did on YouTube on how to file your personal tax, income tax, I would also drop the link on the meeting chat, whereby you are able to see how you are able to file your taxes. So you have a portion for the end income, for your for your salaries, for your income from allowances and all of that. Then you also talk about the income you have earned from rent, from dividend, from interest, from royalties, and different things like that. Thank you.
All right, thank you. So that's the only question on that on the Q&A. So I'll go to the chat. There is a question on the chat saying, I think this has been answered though. It's saying, can you please speak to PIT considering the fact that payee has been deducted from an employee? So Mr. Usugashi has already told us, aside from your payee, you have to file your own personal income tax. So we've been told that, we've been sensitized on that. So you have to go and file your own personal income. So whether you are earning outside your salary or not, please let us file so that we avoid compliance risk. So we can just say it is zero if you are not earning, and if you are earning, you can add that to whatever that you're earning from your employer. So there is another question. What are the real benefits of the taxation in Nigeria that will make all these policy changes really worthwhile. I can say to some extent that Mr. Usugashi has answered this too. Some of this is the fact that if you now own a company that earns less than 100 million, as profits or as income in Nigeria, you are exempted from tax. Before now, the levels are three. There is a mid. After the small, there is mid and there is the large. So many companies fall into the medium in the old tax law, which of course expose them to paying tax. But now that mid has been repealed, and then we now have small company and large company. And so any company earning income below 100 million is exempted from tax. So I guess that's one benefit. Another one is the salary one. So if you earn 800,000 naira below, you are exempted from tax. Though you still have to file your tax obligation with the fact that just file it at zero. So that is another benefit. And Mr. Utugashi, the other benefit that you want to add so that we can see the beauty of this is not just all doom for this tax. We see there are some good things that we are getting from this tax. Another question from Mr. Shonde says, what is the position of NRS, that's the Nigerian Revenue Service, with respect to charging WT of professional fees, i.e. management fees, trustees fees, auditors fees, deducted from mutual fund valuation in Nigeria, because the SEC rule says it's completely tax exempt. So, Mr. Otugaji, do you have an answer to that? Whilst we wait for Mr. Otugashi to answer that, I can say categorically that the Fund Managers Association, we've taken this up with the Reform Committee and the Implementation Committee. As I speak to you now, I'm pleased to inform you that we've written a letter to them, and the letter and our position to them is that the ISA 2025 exempted CIS from taxation, and then so CIS shouldn't be considered as a company because Section 68 of the new tax law sees CIS as a company. So we have a letter before the Implementation Committee and the Reforms Committee, although we are yet to get a response from them. But let me just add that for members' information. Mr. Otugashi, please.
Okay, thank you so much. Let me start from where you stopped. So I have been expecting that question actually, because I know there's that conflict between ISA 2025 and Section 67 and 68 of the NTA. So that conflict is there because ISA say, oh, you are completely exempted, all of this, but NRS is saying, the new tax act is saying, no, you have to pay withholding tax. And then this will be treated, the trust will be treated as a company, whereby the unit holders become shareholders that would now be taxed separately, and then the fund will be taxed as well. So this conflict, what I would advise, which is what you have also done, is to be that the association should pick a position, present a position paper to the committee, the drafters of this tax law, for the harmonization of these parts, because there seems to be a conflict between that act, that section, and the ISA of 2025. However, that doesn't mean we would not do what is required by the tax law, because the problem will be that when you are now facing your tax issues, you now have issues with withholding tax, because the next thing that the NRS will start saying is, no, all of these fees are subject to withholding tax. Why have you not deducted withholding tax? We are charging you. At that point, even if you tell SEC, there will be little to what SEC can do at that point. There will be little to what SEC can do to help you as a company at that point, because other companies will be having similar problem, which is why I recommend that FMAN as a body should come together, write a position paper to the drafters of the tax law, in order to harmonize this, and then let's see if there will be a finance act that will be used to correct this part of the tax law, and then or maybe it will be subject to the interpretation of the Supreme Court, whichever is supreme on this part. But what I would advise when it comes to taxes tax auditors will come and then tell you, we are representative of government. Whatever you want to say, we want to get this tax from you. And you will be relying on the provisions of the ISA 2025. No, we are exempted from deducting any taxes or paying any taxes on these services or on these transactions. There might be conflict at that point. And even no matter how you want to drag it, the tax authority will say, okay, no problem. We'll go ahead to, now practically speaking, they will say, okay, no problem. If you object, no problem. We'll upload that liability on your tax promat. Then if you are not comfortable, you can go to a tax appeal tribunal. However, something I failed to mention with this new tax law is the tax ombudsman, which is very, very important. So the tax ombudsman is like a mediator between the taxpayer and the tax authority. So saying if you have any issue that you are unable to resolve with your tax authority, do not stress yourself. Just come. Let us hear you out. We will talk to the tax authority on your behalf. And if you are not fine with whatever we have advised, then you can go to the tax appeal tribunal. So this is actually a way to ensure that the taxpayer is also speaking his truth or his facts to another person, to a third party that is not in the NRS. To say, okay, it's just like I have come to mediate with the two of you. Okay, what is the problem? Can I listen to your part? Then you have presented your part that no, the taxpayer, the tax authority is asking me to do this. I am not ready to do it. But the taxpayer, as the taxpayer, I shouldn't be doing this based on so sections and so provisions of the tax law. I shouldn't be doing this. Then the tax ombudsman will look at your case and advise that no, this is you are actually correct or you are wrong. They would advise at that point. And if you are not comfortable with that ombudsman recommendation, you can as well go to the tax appeal tribunal. But the best way, like I mentioned, is of two things. One, ensure that FMAN as a body pursue to a logical conclusion the letter that has been written to the committee. That is one. Two is at the point of tax audit, it might be very, very difficult to scale through from tax authorities. So the best thing is comply while you are still on the process of getting this clearance with the NRS. Thank you.
Thank you so much. Okay, so we'll have, because our time is fast spent, although we started a bit late. So I'll have one or two more questions over the chat and allow 2 or 3 questions from Andres, unless those questions have already been dropped on the chat. So there's one question here. Is there any consideration or allowance for inflation when considering capital gains for taxation, especially on the disposal of an asset held over many years? I'll take it again. Is there any consideration / allowance for inflation when considering capital gains for taxation, especially on the disposal of an asset held over many years? Mr. Otugashi, please. Mr. Otugashi, so this is asking that will there be any consideration whatsoever for inflation? And I know that you have masters in finance as well, so that question shouldn't be something new to you. Hello, Mr. Otugashi, are you there? Hello. So while we wait for Mr. Otugashi to answer that question, yes, the slides will be shared along with the recording, perhaps before the end of business on Friday. Someone saying, I'm still confused on PIT if I'm not to file it. If I am to file it, wouldn't be double taxation. Okay, so it's not double taxation. PIT, you are only filing to SEC. You are filing to the tax people. Because your employer would have filed PE on your behalf and would have paid PE on your behalf. So what you are paying is any extra income that you earn outside your 9 to 5. So that is what you are paying on. So it's not a double taxation. They are not taxing your salary because that has already been taxed at the level of payee. But if there are other incomes where you earn, that is what you show to them to say that, okay, outside my salary, I do 1, 2, 3 businesses, and these are my income.
I didn't know my mic was not muted, and I've been speaking.
Oh, so sorry, because I'd asked a question and I didn't hear you speak.
Yeah,
so that was why I
speaking.
was.
I didn't know my mic was muted.
Oh, so sorry. Okay, so please answer that question.
Generally in Nigeria, inflation is not really considered when you are computing capital gains tax. So what is considered is, even if you have held the asset for a long time, what is considered is what is the cost of the asset as at the time of purchase. What is the disposal value as at the time of disposal? Whatever is the difference is the capital gain. So let's say I purchased a building 3 years ago, or let's say 10 years ago for 20 million. Now I am disposing that same building for 300 million. My capital gains is 280 million, less the cost of selling. So let's say for me to sell, I have engaged a valuer, value this building for me. I have also engaged an agent. How much am I sell this building for me? Then I've also done some renovation works so that I can quickly sell it off. So all of these are allowable to be deducted. However, for inflation, that is not recognized in Nigeria as it stands right now.
Thank you. So again, I've been able to answer Dorcas. What you're filing is not your salary again. So because your employer has already paid for your salary, so what you're filing with your PIT is any other extra income you earn outside your 9 to 5. Exactly. Okay, so another question: what is the position of the law relating to expenses relating to tax exempt income? I really do not understand that question. So I don't know if you understand the question.
Can you take it again? I'm trying to see.
Please, what is the position of the law relating to expenses relating to tax exempt income, especially when the income is dividends? So, Abbas,
I do understand that question clearly, but what I would say to that is this. So when it comes to tax, let's say income like dividend, when it comes to income like dividend, it would have suffered withholding tax at the point of payment. That is one. Then for you as an individual, do not forget that withholding tax is not a final tax. Neither is it an additional tax. It is just an advance payment of tax. So let's say your your dividend is 100 million. Just an assumption. I do not say for a fact. Let's say it's 100 million. Do not forget that if you put down 100 million on the tax table, the withholding tax that has been deducted is just how much? 10%, which is 10 million naira. That 100 million, the accurate tax on it, the effective tax on that 100 million is more than 10 million actually. So, but what government has just done is to collect 10 million in advance so that you can now come and pay the balance at the end of the day. So if that is even the only income you have for the year and you want to file your tax is actually more than the 10 million. I do not hope I don't know if the person that asked that question understand what I'm saying, or if that answers their question. If the person could also unmute his mic to also ask the question maybe in a much more better way that we both understand what he's talking about. But for what I see,
so
if you are
this question, because this question sounds interesting, and our time is fast spent, but I want our participants here to enjoy this. For small businesses, business names in particular. So, we have types of company. There's the business name, there's a limited liability. So business name in particular, which is more or less like a partnership or sole proprietorship. Is the business owner different from the business? In other words, will the individual file differently from the business? Because the income, let me just put it that way, because I was going to just explain further with this question. And it's a very interesting question. Please, what's your position on this one?
Okay, so under the Nigerian tax law, you have the enterprise, which is business name, business name and the likes, business ventures. You also have the limited liability company. You have the public limited liability company. So now this is it. If you have a small business and as a business owner, you are not different from that person. You are not different from the business. Two of you are assumed to be the same. So when you want to file, that business will be assessed under PIT, except for value-added tax. If you have caused the threshold of 100 million as a business, then you have obligation to the federal government with value-added tax. But if it is just the tax for that business, then you will be assessed under personal income tax. So now this is how it works. If you watch the video I did on YouTube, you will put, let's say you have employment income. If you have another business that you are doing, if you have income from the business that you are also doing, what means is that you would also put that revenue. I mean, you also put the profit, because at that point, you need to be very careful so that you do not go and put only revenue. Because if you put revenue, let's say you are selling computers and you have sold 50 million naira worth of computers, don't forget that you have a cost. It costs you something to achieve that 50 million. So it means there must have been a cost of maybe 40 million. Let's say the cost you bought it, the cost you transported it, the people that offloaded it, maybe you paid rent and all of these things. So all of these are costs to you. Then the profit, you also add it to whatever you have earned in your computation when you are doing your filing. So when it comes to small business or business name, you are being assessed for tax under personal income tax. Thank you.
All right. Thank you so much for that. Then the last question that I'll be asking from here, though there are a few questions, okay, maybe we should ask, or please permit us to ask so that we can get all of them. For an asset management company, what determines the timing of tax remittance obligation? And why might CIT still be payable on income where tax has already been remitted?
Okay, so when you say tax has already been remitted, do not conflict two things. I mentioned that withholding tax is not final payment of tax. It is just an advance payment of tax. So now, let's say you have made income, your total income is 100 million, or let's say 200 million, and your cost at the end of the day is, let's say, 100 million. Then you have a profit of 100 million. Even if you have suffered withholding tax of, let's say, 10% on that 200 million, that is just 20 million. So now, if you calculate the profit, I mean the tax on that profit at 30%, even if you are not able to exhaust the whole 20 million, you can still carry the withholding tax to the following year. You can still use it. It is your own. It's just like you have gone to let's use a much common analogy here. Let's say while we were in school, we have somebody that sells food in our neighborhood, and then every time we come from home, we just put in 10,000 naira with that person. So we give the person, just take 10,000. So when I'm buying food, be deducting it. So the same way, when you are now paying, so when you have withholding tax credit with the government, and your tax for that year is lower than that withholding tax, you will utilize the withholding tax and then carry forward the balance to the following year. It is allowable. It is your money, but you cannot utilize the whole withholding tax in that same year. And then also when it comes to timing of remittance, so if you have deducted withholding tax, you are expected to file it and you are expected to remit it before the 10th of the following month. Then CIT, I have mentioned it earlier, the 6th month after your year end, you are expected to file your company income tax and pay the taxes where necessary. So when I say where necessary, don't forget that for 100 million and below, you do not have that obligation. The only thing you have to do is to compute it and tax it at 0%. File it. The law requires that you should file it, even though you're not paying the tax. But for the one that is above 100 million that are asked tax to pay, you have to pay that tax. And then another good thing about this new tax law is that minimum tax is now a thing of the past. So before now, even when you make loss, you would pay minimum tax. But with the new tax law now, if you make loss, you will not pay minimum tax. So because if you are paying minimum tax, it means your capital is being taxed. If I have not made profit, I shouldn't be taxed. But in the old regime, we were being taxed on minimum tax. But with this new regime now, minimum tax is no longer taxed. So if you have loss nobody will tax you. But before, it was being taxed as minimum tax. But now it is no longer the case. So I hope this explains, this explains the position to you. Thank you.
Thanks. So permit me to go to the last question so that I can see some hands up. Maybe we'll allow 1 or 2 hands. This webinar is supposed to be for 1 hour 30 minutes. We've been 1 hour 42 minutes now. So what does WHT, does withholding apply to USD short-term investment? For example, if I have a fixed rate note in USD, do I have to remit withholding tax for my clients? So for USD, for investment in
my mic was muted. I didn't know my mic was muted. Definitely you have to deduct. So don't forget I mentioned that if you are making income from Nigeria, so far you are making income, wherever you have, you must deduct. It is subject to withholding tax under Nigerian rule, regardless of the currency. So far you have made that profit from that income from Nigeria, you are expected to deduct the withholding tax and remit for that person. Let's even say the client is an international tax. There's an international tax department that you can actually go to, remit it, and then obtain the certificate and issue to that person. So if that person or that company resides in a country that has a tax treaty with Nigeria, then they are able to use that withholding tax credit. Just the same way it is also applicable to Nigerians when you also invest abroad. Thank you.
Thank you. So we have just 2 hands up, and those are the 2 hands that were allowed to speak. Sorry, I'm trying to get her name. Okay, Abasi Keme, please ask your question. Unmute and ask your question. Mr. Akpan, please. Okay, so while we wait for Mr. Akpan, Mr. Shunde, please kindly unmute and ask your question. You can unmute from your hand, I believe. Oh, okay. 1 minute,
take the
please.
next person. They are able to speak.
Okay, Akpan, I have allowed your mic, and then Mr. Shunde too, I have allowed your mic, so both of you can talk.
Good afternoon, everyone.
Good afternoon.
Okay. So my question is centered around the tax law that says that if an income is tax exempt, then the expenses attributable to generating that income is also going to be disallowed. So I'm asking that in a situation whereby this income is from dividends, it's a dividend income, is it still going to suffer the same treatment where the expenses, because there are no expenses incurred in generating dividend income? So I'm just trying to gain clarity on that. Thank you.
Okay, thank you. Akpan, right?
Yes, please.
Okay, I think it's similar to the question that was asked in the chat box the other time, Mr. Adenekon, if I'm correct.
Yeah, it's something similar, but please kindly just.
So,
yes,
like I mentioned,
I was going to ask the question.
Okay, so now let me reiterate again. So if you read that section 67 and section 68 of NTA, it stated that for fund managers, or let's say for trustees, you have gone ahead to have a fund vehicle, just like the CIS. So the CIS ordinarily shouldn't be taxed, but the new tax law is saying no, we do not agree with that. The trustee is set up like a company, while the unit holders are now excuse me, are now the investors are now unit holders. So whoever owns any unit then would be subject to tax in their own name. Then the fund would also be subject to tax. So this is really inconsistent with the ISA 2025, which is also being contested by FMAN. However, let's say you have earned dividend now, and I don't know the context you are putting, let's say either as a company or as an individual. You have earned dividend. Don't forget that even before that dividend even comes to you, it should have suffered withholding tax ordinarily. So withholding tax would have been deducted by the entity paying you that withholding tax. And the withholding tax is used to offset your future tax. However, let's say you also have expenses that are these expenses allowed. So in the real sense of it, when you talk about dividend, do you incur any expenses? So you have to look at what point are you looking at it? Is it as the receiver or as the payer of the dividend that you are looking at? So for what is it called? For payer of dividend, definitely it's allowable. You have to claim the tax because if you are the payer, you have to get your, what do we call these people that help you do your, is it the registrars or something like that? I think they call them registrars. When you want to pay your dividend that you have to go through. So all of these costs also would be allowable for tax. But because of this conflict between ISA and that section 67, which the FMAN has also presented a position paper to say, oh, we disagree with this based on what the based on what the Securities Act tells us. So that conflict, like I mentioned, that conflict is still there. But be that as it may, for you, you can still claim it and still rely on whatever you still want to rely, because tax is not sometimes emotion, they are facts. What you can also claim and what you can also buttress your facts. So if you have any thing you are claiming, you must be able to also prove to the tax authority that yes, I have also incurred this cost and this is my own position on this issue. Thank you.
All right. So Musa Shode, do you still want to ask a question? Or
yes,
the question
thank you.
Okay.
Yes. Can I proceed? Thank
Please
you very
proceed.
much for the presentation. So my questions are two. Number one is that the mutual funds does placement, fixed deposit placement with banks and counterparties, right? And they are charging us withholding tax on those placements. So my question is, since the mutual fund itself does not have a team, is not a taxpayer, can the company, that we house or that manage the mutual fund, can they claim the tax credit into their tax promise account? That's the first question. Why? The second question is, I know you talked about carry forward unutilized withholding tax credits, right? But I think there was a time where they dragged this issue to court. But can you tell us what was the final judgment of is that the tribunal that was listening to that hearing? Then what was the final judgment, and how long can somebody carry forward unutilized withholding tax credit? Thank you.
Okay, thank you. So let me just be quick and brief on that. So when it comes to utilizing of withholding credits, in fact, I have clients that have been carrying under withholding tax since 2019, some as 2018. So far, you can even drop it on Tax Pro Max. It's even there on Tax Pro Max. So one good thing with technology is that it helps you streamline a lot of processes than necessary. So before then, we used to have issues with withholding tax. You'll be looking for the credits note up and down. But right now, once a withholding tax is remitted on your behalf, you will see it on your portal. So you don't even have to do with anybody. So at the point of you want to file your tax, the Tax Pro Max will even ask you, do you want to utilize your withholding tax? So that is to tell you that you can utilize your withholding tax anytime. So for some people, they would go ahead, they have withholding tax of let's say 10 million, and the tax they have is just 1 million. They will pay 1 million, move to the next year. So even some, they even go, in fact, if you have a very good claim, you can come to me, we can file for tax refund. At least I've done it for clients that they are able to claim their withholding tax back, the excesses they have paid. So just for you to be able to buttress why you are in a withholding tax, excess position. I have done it for 2 clients. They have gotten their withholding tax. So you can actually reach out to me after this call, after this webinar, to actually file filed for refund for your tax, withholding tax. So it's something that you can claim back. It's your money that has been paid in excess. And also to the first question about, okay, the mutual fund has placed funds with either fixed deposit or private placement or whatever it is. So when you have this revenue, now if the what is it called is deducting, where do they remit? That should be the first question. At least if you are deducting withholding tax from a mutual fund, ordinarily it should be remitted somewhere. You can't just deduct and hold it. It must be remitted in favor of the company placing it. That should have been the ideal situation. And then I have, I don't know if they are in this call. I even have some of my clients, they are on this call, and I've explained this to them, that they are even not able to claim their money when they do any placements with any, even some buy CPs and the likes. When they buy, I tell them, follow up with this company that is issuing. Ensure the withholding tax is remitted. If the withholding tax is not remitted to you, write them a letter demanding the remittance of this withholding tax, because it is your money that has been deducted ahead. So always ensure that if withholding tax is deducted from any of your income, ensure that you follow up to the end to see the remittance of this withholding tax to your TIN. Thank you.
Thank you so much. Once again, let's thumb up, let's clap, let's thumb up, let's clap for Mr. Otugashi. And this is promise made, promise kept. For the last 1 hour, for close to 2 hours, he's been here sharing his knowledge. He's proven to us that he's indeed a certified trainer on this new tax law. And he has really shared all the knowledge. So I didn't have to his feather when I was speaking, when I was talking on his profile. He's also a capital market auditor. So like he mentioned, some fund managers are his client that he audits for. So that's why he's able to answer a question very well and vastly, because one, he has a master's in finance, and is also a capital market auditor. So he understands our space very well. And then when we met with him to tell him these are the questions that we've really been having, he was able to answer it. And so, Mr. Awutugashi, thank you once again. We really appreciate you. Please kindly drop that link, a link to your YouTube channel where you have the filing for PIT, the do it yourself filing, DIY filing for personal income tax. Please drop it on the chat box, and then when we are sending the recording and the slides, we will as well add the link again so that we can share it wide and far. Let us engage that YouTube. Let us like, let us follow, let us subscribe. Let us appreciate at least these 2 hours that he has spent with us. Let us appreciate that by liking, by engaging the YouTube channel where he explained he did the DIY for personal income tax. So on behalf of fund managers, on behalf of the executive committee of fund managers, I'd like to say thank you to everyone who's made out time to attend this webinar. Again, this is promise made, promise kept. And as you well know, FMAN, what we do is that we really go into what the problem is and we bring it out so that people can learn from it. The last one we had, it was on the internal control filing, the internal control thing. And we also saw that at that one too, we brought an expert that sensitize us on everything we need to know. So again, we've done that with this tax thing. So once we share this, please share it everybody to people that we know that may benefit from this knowledge. And on this note, I'd like to say once again, thank you, and please enjoy the rest of your day. The recording will get to us on or before the close of business on Friday, God willing. Once again, thank you, and bye-bye.
Thank you so much for having me, everybody. Thank you so much. I'm really grateful.
All right. Yes, thank you, Mr. Otugashi. Thank you. And thank you, everyone. So we will